Hey guys, welcome back to Leon's Money Flow. As always, this channel is about me bringing you guys along my journey to financial freedom, and hopefully I can inspire some of you to start on your own journey too. Today we're going to be breaking down the most common Canadian investing account types so we can understand which one is best for you. So why do account types matter? Where you invest in can be just as important as what you invest in. Taxes can dramatically impact your long-term returns. Here's an example. Let's say you invested $100 weekly into the market and you got an annual return of about 10% a year. Then, after 30 years, you'll have just over $1 million in your account. If this was a tax-free account, then you'll get to withdraw the whole amount tax-free. But if this was in a taxable account, then you would need to pay taxes, and let's assume you pay 25% on it, then that's $250,000. That's over a $250,000 difference just because of the investment account and not anything to do with the investments itself. Let's take a look at these accounts now. So first off, we have the TFSA, which is the tax-free savings account. And this account started in 2009, and it does have a contribution limit, which is made up of your annual contribution limit, which was $7,000 in 2024 as well as 2025, and the unused room carries forward. So the benefit of this account is that the growth and withdrawals are completely tax-free, meaning that it's very flexible and you can invest in stocks, GICs, ETFs, and more, and you don't need to worry about any tax implications. This is a great first account for many beginners. The second account that I want to go over is the RRSP, which is the Registered Retirement Savings Plan. This is designed for retirement savings, and the benefit is that contributions are tax deductible, meaning that you can reduce your taxable income now. Let's hop into a quick example. So if I made $70,000 at my job this year, and then I contributed $10,000 to my RRSP, then my taxable income for that year would be $70,000 minus $10,000, which is $60,000. So another way to put this is that growth is tax deferred until withdrawal, because you do need to pay tax when you withdraw. But the idea is that you'll be in a lower tax bracket by the time you hit retirement. So there is also a contribution limit for this account, and that's calculated by 18% of your previous year's income, and there is a cap, so there's a maximum of $32,490 in 2025. And then this number is added to your unused RRSP contribution room at the end of the previous year, and that makes up your total. The next account I want to go over is the FHSA, or the First Home Savings Account. This is the newest registered account as it started in 2023, and it's aimed towards first-time home buyers. You actually can't open an account if you already made a home purchase. So the benefits of this account are that contributions are tax deductible, similar to the RRSP. And second of all, withdrawals for a qualifying home are also tax-free, which is like a TFSA. So sometimes this can be treated as a best of both worlds account. The annual limit is a fixed $8,000 and the lifetime maximum is $40,000. There is an extra perk of this account is that if you don't end up buying a home, you can transfer your FHSA funds into an RRSP anytime before the account closes within 15 years. This transfer does not affect your RRSP contribution room, and thus you can always think of it as just bonus contribution room. So my strong opinion is just always open an FHSA if you're eligible. The last account that I want to quickly go over is the non-registered or cash account. This account does not have any contribution limits and there's no special tax advantages. You pay tax on all the different types of investment income, including dividends, capital gains, and interest each year. This account is useful once your other registered accounts like TFSA, RRSP, FHSA room is all maxed. Let's do a quick comparison recap. So first you have the TFSA, which is the most flexible as it gives you tax-free growth. Then you have the RRSP, which is great for retirement and tax-deferred growth, which means that when you withdraw your money at retirement, hopefully then you'll be at a lower tax bracket and you'll pay less taxes. Thirdly, you have the FHSA, which is a great tool for Canadians who want to buy a first home, but also a great option if you don't end up doing that, as it will transfer to your RRSP. So you can think of it as just bonus contribution room. And lastly, you have the non-registered cash account, which is a great overflow account if you have all the other registered accounts maxed out. Now that you know which account type is best for you, you can follow my previous video to see how to subscribe if you want to continue following my journey to financial freedom. Next week, I'll be creating a video on income investing and why to consider it, so be on the lookout. Thanks for watching. See you in the next video.